Hi, everyone. Thank you for being here. We have only 20 minutes, so we're going to try and make the most of it. And hopefully, by the end of this session, you will learn all about how to run a fund in the crypto space. So we're going to just jump right in. My name is Jane. I'm an associate at Winklevoss Capital, focusing on crypto. If you could please introduce yourself, name and fund, and kind of what brought you into crypto originally. What was like the most exciting hook?
Awesome. Thanks. My name is Jake. I'm the founder of Coin Fund. We're a crypto fund based in New York, been around since 2015, today backed by the partners at Venrock. What brought me into crypto is that I had a hacker friend in 2011 who showed me Bitcoin.
Thank you. Hi, I'm Mable, partner at Nirvana Capital. We base in Beijing, but we have a few venture partners in New York and San Francisco. We started off in year-end 2016, and then I guess my exposure to crypto is really the virtual collectibles.
Good afternoon. My name is Jehan, and I'm the managing partner and co-founder of Kinetic. We're based in Hong Kong. I'm also the co-founder of Social Alpha Foundation, which is a charity which gives grants to projects using blockchain for social impact. And I got into this space actually, coincidentally, from the twins, because we were both on the same cap table for a startup called paddle8.com, which is an art auction. And so through that, I kind of got interested in Bitcoin initially, and then obviously kind of went to the rabbit hole. So.
Hey guys, I'm Nick. I run a crypto venture fund called One Confirmation based in San Francisco. And I got into crypto, I think like a lot of people, I read a Wired article back in 2012 talking about this magic internet money that was being used to buy guns and drugs on Silk Road. And I've always been an online community person, so the first thing I did was jump onto r/Bitcoin and Bitcoin Talk, the two forums, and saw the social movement that was happening and got hooked.
Cool, thanks everyone. So we're just gonna do popcorn style for the rest of the session, so feel free to answer or not answer. How should funds think about structuring? So if you're a new fund manager now, how should you choose between liquid and liquid structures, split between liquid and illiquid holdings, and what would the thesis be on portfolio support and time horizon for investments? This is like the optimal fund, not necessarily your own.
Yeah, I could start. I mean, I started, launched the fund in 2017 and was one of the first to structure it as a venture fund. I think I feel pretty strongly that a venture structure is the right structure for this space. At that time, there was a new crypto hedge fund popping up every week, and there's two reasons why I think the venture fund is the right structure. One is, I view public cryptocurrencies, whether it's Bitcoin or ETH or whatever, as kind of having venture-like risk reward, where it's either even Bitcoin today is 10x plus or zero, and so trading on a short-term basis. Maybe some people are good at it, but that's, for me, not my skill set. And I think it's really hard, given just how immature and how little data there is in the space. So, having a venture structure, which, for those that don't know, is 10 years, and you don't call capital all at once. You call it on an as-needed basis. That's a big benefit of venture structure. And then the other thing is kind of incentives, because there's, with hedge funds, there's this fundamental misalignment in incentives between the GP and the LPs. And that meaning, if you're running a crypto hedge fund, you collect carry annually. So, what happened in this space is in 2017, you had a lot of crypto hedge funds that were up huge. And that's money in the GP's pocket. Meanwhile, the LPs, don't get anything. And in 2018, now you're down big, and the GPs still are up big, and LPs are down. And so, as a venture fund structure, I only make money when my LPs make money, and so there's more of this alignment and incentives between the GP and the LPs.
So I think that how a crypto fund structures, largely depends on what they're trying to do. Like in the beginning, everyone was just sort of experimenting with a lot of different models, and what we see now in the crypto fund space is a bit of professionalization and specialization into different strategies. You have quant funds and VC funds and hedge funds, and All that being said, I think there's an opportunity to be a crypto fund, which is a bit of a different structure than what has come before. And so, like when I think about like what are we investing in blockchain, I think about investing in decentralized networks. And what we're seeing is a very clear evolution of how those networks come to be. And it turns out initially you have kind of a private company with equity where the team bootstraps the network, and then you have a phase where the supply side of the network is bootstrapped, and so you have people like stakers and miners participating in the network. And then later you perhaps have a liquid asset for that network that you can trade in secondary markets. So traditionally, like VCs have been really good at like the first thing, and hedge funds have been really good at the last thing. But if you are a hybrid structure, like if you can invest in equity and tokens and SAFTs, and you can also stake, I think that creates a lot of optionality on how you can participate in the life cycle of decentralized networks, and therefore is a better risk management strategy.
To pick up what Jake was talking about, I think the choice of LPs is quite important as well. I think to some extent, there are a lot of institutional investors that they do invest in funds, but there are certain restriction on the equity or token deals and whatnot. So like, in terms of like choosing the LPs, I think we are probably more going to focus on the individuals, like who have the understanding of the space and whatnot. But at the same time, you would be able to elaborate like what you were trying to do and have them have a similar level of trust to the investors. So that's like a very important part. So like, I think instead of getting whatever money that you could get, like selecting the LPs would be a very important part for a crypto fund to have a long life living.
Yeah, I don't have a whole lot to add other than what everyone has been saying already. I do think that it's a balance between being in service to your LPs and also being in service to the companies you're investing in. We started off, with our own money, basically just investing in both tokens and equity, and it was really nice to be able to have that flexibility to kind of experiment and put capital in and also take capital out. But of course, I think for equity investments, which is really our focus right now, you can't really be doing that. At the same time, you have to educate your LPs, and many first-time investors or LPs that are coming into the blockchain space, they want to be able to have a taste of different things, and being able to help them on that path, I think and the options and the different structures to kind of invest is flexible. So if you have the luxury to be able to invest in both and offer both to your LPs, then I think generally it will be good.
Kind of expanding on Jake's point, how do you think about leveraging alternative models for return generation that are unique to the crypto space? This would be like staking and generalized mining and things like that.
So just like as a data point, I would say generalized mining has been a significant percentage of our return this year. So something to the tune of like 30 to 35%, which shows that it's a differentiating strategy. I personally find it like super fascinating to be able to engage like a protocol or a decentralized network directly and be able to earn a return from that versus some of the more like traditional ways of investing. But more importantly, in blockchain specifically, sometimes that's the only way you can get certain kinds of exposure. So like one example of that would be like layer 2, right? Around 20 or so projects last year working on state channel networks, and most of them don't have tokens, and equity models are sort of far off, right? If you look at the really decentralized versions of these networks, you start to sometimes think that like maybe the way of capturing the value of this network is actually to be running, a hub or some kind of auxiliary node on that network. And part of experimenting, I guess, with models of investing is like trying out those kinds of things. So I think it's like especially important to experiment with those things in blockchain.
I guess I take a slightly different approach here. I think my view is, generally speaking, and this is true in cryptocurrencies and it's true in whatever you're doing broadly, is that focus is a really good thing. And I think one thing that definitely happened in the industry over the past 2 years through the last bull market is when things do great, and prices boom, you have a lot of different opportunities. You have people throwing capital at you, and you have a whole bunch of different avenues you can do. And what I've seen for myself, but also for the companies that I've invested in, is being focused on what your core competency is really important. And I think that's something that I see a lot of people still making, a mistake that a lot of people are making in the industry is not focusing. And so for me, if generalized mining or running nodes and things like that is your core competency, then I think it makes a lot of sense to take that strategy. But for me, as an early stage investor that's looking to kind of identify the best opportunities and then work with founders in the early stages of the project to help, that type of thing would be kind of a distraction for me. And so, staking is certainly important, and we're investing in a number of staking tokens. But there are services that we could use to kind of outsource that work, and that's what we do.
Yeah, I tend to agree with that. I think that staking is probably one of the best things that one of the early stage investors of a token project can do to really help solidify the network and also signal, like that early signal that one of the major investors in the fund or in the project is actually going to commit their tokens and maybe not even sell whatever comes off of it in terms of the yield, but just continue to roll it. I think that is very important. It's a really good way to add confidence and stay long-term aligned with the project. And just from a relationship standpoint, I feel that they really appreciate that, that you're kind of sticking with them. So at least in the early days, proof of stake is still early. That is one of the ways that, I think that we try to help them.
Right. To add on Nick's point about, in terms of the project, what really we cares about, it's not like whether you're doing a token or equity, it's like what it's appropriate for certain things. For example, some of the layer 2, we kind of come to agreement that it really doesn't need a token, but at the end, the token doesn't really capture what the values had to bring to the platform. And at the end, the investors doesn't really capture what they invested in. So that would be our problem. So I think for us, what we really care about is helping out the projects to think through what they, how do you really kind of derives the values and then, make sure that everyone who invested in the platform or in the project captures that. So I think that's...
Moving on a little bit to talk about the state of the market, what do you think are the major headwinds and tailwinds influencing crypto's path to mass adoption in the maybe 6 to 18th month range?
I think that one of the kind of tailwinds that I think we're really seeing, for better or for worse, is really the kind of rise of enterprise, kind of tokenization and blockchain for enterprise. We have this kind of idea of an enterprise-first growth strategy where the first 100 million customers will come from enterprise into blockchain and crypto, and I think we're seeing that play out with the Libras and the Rakutens and the Lines and Kakaos and can go on and on and on. I think ultimately it will benefit a lot of the startups in this space who haven't been as good at customer acquisition and who've really struggled. I mean, really great technologies, that were early in this space that really struggled to find their kind of product market and really any market. If they can kind of hang on long enough for some of the larger kind of corporates to bring in and normalize the conversation and normalize the practice and the interfaces of dealing with crypto and blockchain, then hopefully we'll have more diversity in the long term. So I think that will be a big boost. And as problematic as Libra is in so many ways, on the same token, it's been really, really helpful to not only force the kind of conversation from a regulatory standpoint, but also bring a lot of others, corporates. I mean, with Walmart and also Allianz, I mean, there's going to be a whole bloom of kind of corporate tokens, which I think will make the entire ecosystem easier for adoption.
Sorry, go ahead.
I guess I'm being a little argumentative here, but I disagree with that. I mean, I've seen kind of enterprise names get into the space dating back to 2012 and 2013 when I was at Coinbase, and in the early days of Coinbase, we were initially focused on merchant adoption, and we were incredibly excited when we onboarded Overstock.com as the first online merchant to accept Bitcoin. Right, it was a huge win for us as a company, and it was huge for the space in general because it legitimized cryptocurrencies and Bitcoin in a lot of people's minds. What we quickly recognized is that merchant adoption was all about kind of these merchants that were struggling getting their names in the paper, and they wanted to be perceived as innovative, and that it didn't move the needle for us, right? Such a low percentage of people were using cryptocurrencies, and it was a PR gimmick. And so, I tend to think that, and again, this could change. I could very well be wrong on this, but my view is that these enterprises, getting in the space, it's good for credibility, I guess. I would argue the space is pretty credible now. I'm not sure that we necessarily need that, but so for me, like the next 6 to 12 months, there's really two things going on. One is kind of cryptocurrencies as an investment, right? And I think Bitcoin, my expectation is that Bitcoin is going to continue to lead the space higher. And Bitcoin is one thing, right? It's digital gold, but it's got a clear story that institutions are starting to understand. And I think I'm not that excited about Bitcoin from an innovation perspective, but from an investment perspective, I think it's likely to lead the space higher. And other cryptocurrencies that are serving this kind of store of value investment case. And the other thing that is really important, and why conferences like this are so important, is kind of this grassroots movement that's happening to enable kind of new use cases beyond investment/speculation, right? And that's things like DeFi that we're seeing in Ethereum, and it's kind of next-gen dApp platforms that hopefully will enable new use cases, things like Cosmos and Polkadot. So that's what I'm excited about.
Interesting point, because I was going to say that I think the tailwinds and headwinds is actually the same thing. It's a corporate versus DAO. Like the company structure at the end of the day, it's by nature, it's not going to be like it's going to be very centric. Everyone wants to capture the values, the new dividends in the equity. But on the other hand, like what DAO was trying to do was like the opposite thing. But I've been thinking about a question that's like, what in the future 5 years or so, like, DAO versus company would evolve into? Would a big platform kind of serve a lot of DAO on top of it? And then how would all these companies become? Like, would any of those, like the Web2 kind of creation, kind of evolve themselves or transform themselves into relatively Web 3.0, like decentralized and more data privacy friendly kind of platform? Because like at the end of the day, decentralization, it's not completely anti-platform. So like to Nick's point, I agree that I see a lot of the big platforms are just for their own sake, for their shareholders, or trying to boost the price, the stock price, and just doing a lot of the quote unquote decentralized, platform and whatnot. But on the other hand, it's similar to what we saw back in the days when the open source movement, we certainly know that the software should be, charging back then, but still a lot of people will see the potential for creating an open source movement. So I think it should be kind of moving in parallel, and then we don't know like which of the company, but would kind of create a decentralized or Web3 friendly kind of platform. But I think it's hopeful. Yeah.
Okay, so we're almost out of time. 2 really quick takes. First one, which categories are you most excited about right now? Like a couple words only.
DeFi banks.
Yeah, derivatives related.
It's not a popular thing these days, but security tokens. I'm still very bullish on security tokens.
DeFi and next-gen dApp platforms.
And final question, what is a controversial opinion that you hold close that pertains to crypto and blockchain?
You don't have one? I think he could probably say a lot, but I think this is like very project focused. But I think Algorand is definitely very undervalued right now because a lot of people don't see the potential of it's doing the on-chain auctions completely on-chain, 100%. So that's like a big, it could be a next big thing for like similar to Ethereum. Could be controversial.
I think it's always hard to answer these questions because, controversial to who? I think, to the outside world, saying that, cryptocurrencies are going to be over $1 trillion is very controversial. I think to most people in that room, that isn't. So I guess for me, though, maybe for people in this room, and sentiment I hear in crypto, there's a lot of frustration about, projects like Augur, right? Augur's one of the first ICOs. They've been around forever. The team has been working on this thing for a long time, and they got out a product, and no one's really using the product, right? And so I think there tends to be a lot of negative sentiment about projects like this that have been around for a while, and nothing is really happening yet. And I'm very bullish on projects like this, and it's very situational. It's got to be the right team and the right product. But for something like Augur, I think when there's a team that has kind of deep historical context that have been working for many years, and they're working on the right product, even though it hasn't happened yet, I think I want to continue to bet on teams like that. So a project like Augur, another one that you could say is MakerDAO, which ETH collateralized is now declining, and people are getting worried about that. And so projects like that, I'm very bullish on.
Similar to what I was saying on the enterprise side in terms of adoption, and enterprise adoption driving kind of overall space adoption, maybe a corollary to that is that the path to full decentralization passes through semi-decentralization. And some of these larger corporations who will have areas of their business as kind of sort of semi-decentralized aspects and using blockchain but in permissioned ways, and that being a way to actually kind of develop a lot of the kind of traction to get to full decentralization.
Kind of controversial. I tend to think that like long-term, highly decentralized permissionless things will win over, sort of semi-decentralized things. And like one way that you can get a glimpse of why that might be true is, folks who are navigating the, the regulatory compliance sort of space, and they're often faced with a kind of choice of like spending a lot of capital and compliance and being very limited in what they can do versus kind of becoming, perhaps a non-custodial platform or use some other property of decentralization to like lower those costs. And then what that ends up doing is creating incentives for systems to become more decentralized, more permissionless over time. And I think over time that compounds and kind of wins.
Cool. We're done. Thank you, guys.